Welcome to AI Ecoposo, where we analyze major financial shifts to help you invest smarter. Imagine a scenario where China cuts off all exports to the United States. Could this happen? And if it does, what would be the consequences? The United States heavily depends on Chinese goods, ranging from consumer products and electronic components to raw materials. This dependency has grown over the years, making the U.S. economy vulnerable to any disruptions in this supply chain. If China takes this drastic step, prices will skyrocket, leading to inflation that affects every American household. Financial markets will descend into chaos, with investors losing confidence and stock values plummeting, and millions of jobs will be at risk, particularly in industries reliant on Chinese imports. Can the U.S. economy survive this, or will it collapse under the pressure of such a significant economic shift? Recently, the United States imposed strict export controls on high-tech industries such as semiconductors and artificial intelligence, specifically targeting Chinese companies to limit their technological advancements. In response, China banned exports of critical materials essential for high-tech industries, escalating trade tensions even further between the two nations. These restrictions have pushed China to prioritize self-reliance, heavily investing in research and development, especially in artificial intelligence, telecommunications, and semiconductors. This strategic pivot is not just about technology, but also about securing economic independence and global influence. Strategic partnerships like the Belt and Road Initiative are helping China reduce its reliance on U.S. technology. This initiative is creating new trade routes and economic corridors, enhancing China's global reach. Meanwhile, U.S. companies like Nvidia and AMD have reported significant revenue losses due to restricted access to the Chinese market, highlighting the far-reaching impact of these geopolitical shifts. Looking back, the U.S.-China trade war began in 2018, marking a significant shift in international economic relations. It has disrupted global trade flows, affecting supply chains and international markets across the world. Tariffs were imposed on hundreds of billions of dollars worth of goods on both sides. American farmers suffered greatly, facing increased costs and reduced market access. To mitigate these impacts, the U.S. government provided over $28 billion in aid from 2018 to 2020, aiming to support the agricultural sector. Increased costs have weighed heavily on U.S. businesses and consumers, leading to higher prices for everyday goods and financial strain on many households. Can the U.S. reduce its reliance on China? While efforts are underway to rebuild domestic supply chains and find new partners, this will take significant time and resources. U.S. companies must plan long-term strategies to counter China's growing competitiveness. If China truly cuts off exports, both sides will suffer substantial losses, with severe implications for the global economy. To prepare, identify potential investment opportunities and strategies to protect your assets during these volatile times. Don't forget to subscribe for more updates.